Hi everyone, welcome to this first ESCoE webinar series on economic measurement. I'm Paul Labonne, I'm a PhD student at ESCoE and King's College London, and I will be co-organizing this webinar series with Charlotte Menck. We are very happy to have Martin Weale as our first speaker. Martin is a professor of economics at King's College London and is an expert on economic statistics. He has been working with the ONS for many years now. And today, Martin will discuss household cost indices. The presentation will be about 50 minutes. And then that leaves time at the end for questions. So if you have a question, please ask them in the Q&A box and we will go through them at the end. So Martin, if you want to start, thank you.
Thank you very much for inviting me here to give this talk, at least remotely. And as Paul said, the topic that I want to discuss is household cost indices. Now, for those of you who aren't aware, this is a specific reference to an experimental series that the Office for National Statistics has been producing as a complement to what I might call its more conventional measure of inflation, the consumer price index, which has recently been extended to include the costs of owner-occupied housing as CPIH. So why was there perceived to be a need for household cost indices in addition to the consumer price index or the augmented consumer price index CPIH? Well, the origins, I suppose, lie in a perception that the conventional consumer price indices didn't satisfactorily represent inflation as experienced by households. So John Astin and Jill Leyland in 2015 produced a paper for the Royal Statistical Society, which argued that this index, the household cost index, would be better at, as they say, providing a measure of inflation as perceived and experienced by households in their role as consumers. They make what in my mind is perhaps a not terribly helpful distinction between this index and the macroeconomic needs. There are some macroeconomic needs for which one requires a very specific price index. If, for example, you want to construct national accounts on a chain-linked basis and you want to construct national accounts in current prices, then the price index that falls out, the price index for consumption which falls out, is precisely defined and you have no discretion about it beyond, of course, any discretion you might have about what you include in either consumption in chain-linked terms or consumption in current prices. On the other hand, if you're talking about a policy target, a target for, say, the Monetary Policy Committee, then the target for the Monetary Policy Committee could be anything that Parliament or the Treasury Committee or the Chancellor of the Exchequer thought was appropriate. There's no particular macroeconomic reason for wanting to follow the consumer price index or the consumer price index with housing, beyond, of course, the general point that it makes sense for the Monetary Policy Committee to be targeting an index which is generally regarded as important and is a widely understood indicator of the state of the economy. Now, underlying the idea of measuring inflation as perceived and experienced by households has been, at least to my mind, a sense that perhaps the existing measure of inflation wasn't doing that. The existing measure of inflation, CPI, CPIH, is defined by looking at the average expenditure of all households, the shares of total expenditure on the various categories of goods and services that people buy, and aggregating the changes in those individual costs on the basis of those aggregate shares. It pays no attention to some items of expenditure. Taxes are one obvious item, interest charges are another obvious item. And the view was that certainly with regard to interest, people did regard interest charges as an outgoing from their budget, and if interest rates go up, that obviously decreases the living standards of people who have interest bills, and the sense was that that would be something that households would regard as inflation. I mean, I should say that from my own perspective, I'm not terribly comfortable with the idea of defining an index on the basis of household experience without having a clear idea of what household experience is. I had a question raised in advance of the seminar by Andrew Baldwin asking why did we need a theoretical basis for an inflation index or a cost index at all, and my answer to that question is given by Richard Stone, one of Britain's most distinguished economists who won the Nobel Prize for his work on national income accounting. He argued that you need a theoretical arrangement, a theoretical construct for data, otherwise you end up with data items that are unrelated to each other, like the objects on a junk heap. In other words, you need to have some framework for the data that you put together. And in the talk today, I suppose what I'm going to try and do is to think about the framework that would support the household cost indices and their distinctive nature. Now, I see four distinctive items, four distinctive characteristics. The first is that they're produced using democratic weights rather than plutocratic weights. The second is that they treat gross insurance premia as costs, and this is different from the way in which the Consumer Price Index treats them. Thirdly, they treat interest payments of costs, but noteworthily, they don't offset interest receipts. Interest payments don't feature in the conventional Consumer Price Index at all. And finally, they try, although succeed only in a relatively limited number of categories, to link expenditure to the time at which the payment is made rather than the time at which a particular good is consumed. So let me consider these different features in order. What can we say about democratic weights? Well, where did the idea of democratic weights come from? What's the difference between democratic weights and plutocratic weights? As I mentioned earlier, the weights in the conventional price index are calculated by looking at the average shares in total, at the averages, or looking at the shares in total expenditure by the household sector as a whole. And these are plutocratic because it's quite easy to see that if you look at shares in expenditure by the household sector as a whole, then that measure will reflect the consumption patterns, the spending patterns of those households that are spending a lot of money. It won't reflect the consumption patterns of those that aren't spending very much money. My late colleague at the National Institute of Economic and Social Research, Zig Price, produced a paper in 1958 arguing that one should instead construct an index around democratic principles. You look at the expenditure pattern of each household and you take the average of those expenditure shares. You can see that if you do that, you give the same weight to a wealthy banker as you do to someone living on benefits. So it's a measure that treats each household equally in assessing people's exposure to price changes. In some work I did with Andrew Aitken, we showed that this was actually a rather helpful idea, that it essentially made sense if you thought that social welfare was represented by the log of consumption or by the average of the log of consumption of each household. Why should I want to relate social welfare to the log of consumption rather than the level of consumption? Well, if it's related to the logarithm, it obviously implies diminishing marginal utility of consumption. £100 to a wealthy banker are less valued than £100 would be to someone living on benefits. So, you would want to reflect that, and there is now a body of evidence to suggest that a logarithmic function is a reasonably good way of approximating the way in which the well-being that people derive from consumption changes with the amount of their consumption. To justify it, you also need to make the assumption that individual household spending patterns are invariant with their income, but you don't need to make the assumption that everyone has the same spending pattern. With these assumptions, you come to the conclusion that growth of social welfare is the mean of the growth rate of the consumption of each household, and the mean of the growth rate of each household's real consumption is given by the growth of the geometric mean of income deflated by the democratic price index. So this is saying that if we want to use a democratic price index, it's actually rather helpful because it allows us to work out a measure of change in social welfare, which I think is reasonably easily explained. It's the average of each household's growth in real consumption, and we can do that in quite a straightforward way. I should add, as an aside, that the conventional price index would do that to the average of household consumption only if you thought that £100 of extra spending was of no more benefit to someone on benefits than it is to a wealthy financier. So the democratic price index seems to be a much better idea if we want to represent the average of households' expenditures, but it does have the implication that if the ONS is to exploit this series to the full, then it should encourage people to focus on the geometric mean of income as well as, or perhaps I should say, rather than the arithmetic mean of income. So how much difference does it make? Well, the household cost indices are provided for different deciles as well as for the household sector as a whole. So what I did was to look at the growth in nominal incomes between 2010 and the 2018-19 Living Costs and Food Survey. I looked at the bottom decile, the 6th decile, so that's people just above the geometric mean and the 10th decile. And I drew on the public access records, so very high income figures are top coded for confidentiality reasons, so that makes the very high figures, perhaps, well, I should say, purely illustrative. But what you can see is that the difference between the arithmetic mean and the geometric mean was more pronounced in the 1st decile and the 10th decile than it is when we look at the middle of the distribution. And that's perhaps not terribly surprising, because the extreme values lead to distinctions between the arithmetic mean and the geometric mean, and those extreme values are going to be primarily in the 1st decile and in the 10th decile. So certainly once the ONS is talking about decile experiences, then it is particularly important that it should focus on the geometric mean and not just the arithmetic mean. But subject to that, I think the production, the mainstream production or the nearly mainstream production, the indices are still experimental, the nearly mainstream production of a democratic price index is something to be, for which we should thank the ONS. It is, if taken to its logical conclusion, to make it possible to have discussions about economic welfare in a more informed framework than we can do at the moment. So what about gross insurance premia? At the moment in the consumer price index, I pay an insurance premium for my car. If I have an accident and need repair work on the car, the repair work is treated as normal consumption. The payment out of the insurance for repair work or whatever is treated as a component of normal consumption, and the cost of insurance is seen just as the cost of the insurance company in collecting premia from a large number of people and assessing and paying out on a relatively small number of claims. The treatment proposed here is instead that gross insurance premia should be treated as a cost. And why is that something desirable? Well, it comes down to the fundamental question, what is consumption? Is consumption the enjoyment of goods and services, or is it simply the purchase of goods and services? Obviously, if I have a car accident, I have to pay to have the car repaired, but all I'm doing is restoring the status quo ante. By making that payment, I'm not increasing my enjoyment of goods and services compared with a situation where I hadn't had an accident in the first place. An alternative way of looking at it is to think of a distinction between purchases and enjoyment, because we have a loss of goods in transit. One example you can think of is if someone buys eggs and there's a risk of some of them being dropped on the way home. You don't enjoy any utility from the eggs that you drop on the way home, but at least in principle, it is possible to consider an insurance policy that would protect you from the losses arising from those eggs, from those damaged eggs. Well, for welfare purposes, I think it's easy to see that it's rather better to look at what people actually enjoy than it is to look at their purchases of goods and services. So one way of describing it is to say that insurance financed consumption makes good losses, while other consumption purchases increase utility. And if we want to measure well-being and changes in well-being, then if people are having to spend more to make good losses, we wouldn't want to say that that is an increase in well-being. So if the risk of dropping eggs on the way home goes up and the insurance costs rise, we wouldn't want to say that the extra eggs that people are buying represent an increase in their well-being. All they're doing is making good, an unfortunate change in circumstances which has led to an increase in the costs of enjoying, a particular level of egg consumption. So the household cost indices, I think, are quite helpfully seeing the increase in premia in such circumstances as an increase in costs, whereas in the framework that's used for the CPI, we would see it as an increase in volumes. And I should also say that there's no terribly strong case being made for the conventional treatment. It was something that was adopted in the late 1940s or early 1950s because it was thought helpful to treat insurance in the same way as banking, and that had the implications that I'm describing, that the cost of insurance is seen just as the insurance margin, and any change in the riskiness that the insurance policy is protecting you from is seen as a volume change in consumption rather than a change in the cost of living. Now, if this approach were to be extended to the consumer price index and the national accounts, that would require identification of losses in consumption as an extra category of demand. There is perhaps quite a good argument for saying that it would be nice to do that, but nevertheless, I don't think it is seen as anyone's priority. Nevertheless, as I should say, the economic case for doing so is clear if you want to measure welfare rather than product. And of course, the national accounts were set up to measure product, gross domestic product, rather than to measure welfare. Welfare and product are different things. What about interest payments? Well, the basic theory of price indices does extend naturally to include both taxes and interest payments. You can take the underlying theoretical framework which asks the question, how much do people's receipts have to change to deliver the same level of utility? And plainly, if they have to pay 20% of their income in taxation, and the only thing that changes is that the amount of tax they have to pay goes up to 21%, then it's fairly easy to say how much of an increase in their income they need to offset the effect of that increase in taxes. But nevertheless, interest rates and tax rates aren't quite the same thing as prices. If the interest rate goes up from 1% to 2%, you probably want to take account of the fact that the things people are buying with the borrowing that leads to the interest payment, though the price of those may also be going up, and explicitly or implicitly you have to index non-consumption outgoings to prices or to some subset of prices. Now, that is exactly what the retail price index has been doing with interest on mortgages. It uses a profile of houses or a profile of house prices because, of course, there are some people who have bought houses or flats fairly recently at today's prices. There are other people who bought their houses or flats in the 1980s, but may still have mortgages outstanding on them. Now, even if you take the view that taxes should be left out of these indices, they should look at what's happening after taxation, you can make a strong case for setting up an index which focuses on net rather than gross household interest payments. Why would I want to focus on net rather than gross interest payments? Well, if we want to say, how does the living standard of the average household change when the interest rate, say, increases, then the living standards of people who are paying interest will, of course, fall. The living standards of the households who are receiving interest will rise. And if we want a single aggregate measure which reflects the experience of the average household, you would want to average across those two effects. The household cost indices, in contrast, focus only on payments of interest, and they don't take account of interest receipts as well. And as far as I can see, this has to be justified on the grounds that households' actual experience of inflation reflects interest charges, but doesn't reflect interest receipts. Now, of course, if you maintain an index which reflects only interest charges, you would want to compare that with a measure of income which reflects interest receipts. So you have income and you look at the changes in the things people spend their income on. So why is that a concern if one has a household cost index which is working on this basis? Well, the argument is that the income data are unlikely to be as timely as the cost data. So an index which focuses only on which focuses on gross rather than net payments may give a misleading impression about the way the living standards of the average household are changing. Now, you might have expected that with democratic weights, that wouldn't make a lot of difference. You might have thought, and indeed I did think until I looked at the numbers, that there would be a small number of very well-off households receiving quite large amounts of interest income and a large number of households with interest payments. So even if the interest receipts appeared important on a plutocratic basis, they wouldn't appear important on a democratic basis. Actually, to my surprise, that turned out not to be the case. Well, this slide here defines the way in which I've done the calculations and the variables that I've used. These are of course subject to the Office for National Statistics pointing out that I've used numbers I shouldn't have used or have used them in the wrong way. But anyway, here's what I found. So in 2010, the average across all households' expenditure was £406 a week. Receipts of interest were £5.66 and payments were £25.66. Now, you might say with the payment figure, that doesn't reflect the experience of people who've just bought houses, but as I said, it's an aggregate across people who've just bought houses and people who bought their houses for much lower prices in the 1980s and may well have paid off their mortgages completely. So we can work out plutocratic weights in the next row of the table, and then I worked out democratic weights, the averages of the expenditure shares in 2010. And I did the same thing for 2018 to 2019. And I also did the exercise for households where the household reference person was 65 or older. And you can see that if you look just at old people's households, then you get a very different pattern from what you would get if you look at the household sector as a whole. So interest receipts were about 2 to 3 times those of the household sector as a whole, and interest payments were much lower. Of course, that reflects the fact that many, but not all, old people have paid off their mortgages, and they may have savings and be living partly on interest income, or at least they may have been doing that when interest rates were still somewhat higher than they are now. So what does this tell us? Plutocratic payment weights are higher than democratic weights, but the reverse is true for receipts. On a democratic basis, receipts are more important than they are on a plutocratic basis. And receipts were about 40% of payments in 2010 and 27% of payments in 2018-19. So if I look at the second period, 2018-19, that's saying that the impact of an increase in interest charges, assuming that that increase in the interest rate is reflected in both payments and receipts, would be overstated by about a third, 27 out of 73. It would be overstated by about a third if one looks only at payments and doesn't net off receipts. And if we want to look at something which is relevant to retired households, receipts are about 5 times payments. This, of course, identifies a general issue with using broad indices for uprating particular benefits like pensions, because the expenditure patterns of people who are receiving pensions may be very different from those of the average households. So what I could say is that despite expectations, or at least my expectations, the impact of leaving out interest receipts can be relatively material. Now, it's quite possible that high overhead charges on credit card interest mean that receipts are more sensitive than payments to interest rate changes. So if one does want to look at the effects of interest rate payments on living standards, or interest rate changes on living standards, then perhaps more detail is required. But all this suggests to me that the HCI approach is unlikely to be a good indicator of the effects of interest rate changes on living standards, and that it may work well for relatively poor households. But of course, if you want a cost of living index for relatively poor households, then the right thing to do is to construct one for that particular group and not use an average across the economy as a whole. What about the timing of purchases? Well, essentially, the household cost indices are constructed, at least in principle, on a cash flow basis. People, the suggestion is, have a sense of having to find the money that goes out of their bank accounts or out of their pockets, and that is a cash flow concept. If you buy goods on debt, you pay for them after you have done the consumption. If, on the other hand, you save up to buy goods, you're saving up to pay for, you're saving up for things before you consume them. And my view is that if you see debt-financed goods, identify goods paid for after consumption, then for the index to be coherent, you also need to do something about savings finance goods paid for before consumption. Now, obviously, handling the latter is a bit complicated because much saving may be unhypothecated. You may be saving up for a pension. You may know roughly when you expect to be doing your consuming, but you don't know what you're going to be consuming on. But anyway, a cost index which relates to the time of payment is a cost index for cash flow and not a cost index for consumption. And the theoretical context for that, I think, is rather hard to unravel because most economists think that utility is derived from consumption and not cash flow. You enjoy the holiday while you're having it and not when you come to paying for it, whether you pay for it in advance or after the event. So given that, it perhaps becomes rather difficult to identify, how you would apply this cash flow principle coherently. And so far, the principle has been applied to student loans. Now, my view is that student loans have many of the characteristics of a tax. The amount that you repay while you have a debt depends on your income and not on the amount of the debt. The repayments stop after a maximum age. So my own view is that actually including student loans as a tax might not be a bad idea, although it does raise the question of other forms of taxation. But is it better to extend this timing principle to all practical areas or to limit it to student loans? Well, discussion otherwise has focused mainly on items bought on credit. Now, it's perfectly possible that for some items you get a better fit against the consumption profile. Car repayments, for example, may be better matched to the consumption of car services than is the purchase of a car. So you may actually be matching your consumption better by looking at repayments. But on the other hand, it's hard to say that that's true if we look at a holiday. Pensions in particular are a clear payment for future consumption, and we can identify a price of future consumption relative to current consumption by means of an appropriate interest rate. So would we want to try and include those in a price index or in a cost index of this type? Well, you can say that people clearly see pension payments as a cost that has to be met, and if pension contributions rise because interest rates have gone down, then that is something that has to be met. It leaves less room for other consumption. So there's quite a strong case to say that you should try and address pensions in this way, but there are a number of reasons perhaps why you wouldn't want to. One is that the Living Costs and Food Survey, the data source for consumer price indices, includes only very limited data on pension contributions, and it has no information on occupational pensions. It shows very small amounts of contributions because it considers only a particular subcategory. So there is a data issue. You would need to draw on some other survey, such as the Wealth and Assets Survey, and that, particularly with a democratic price index, would have all sorts of complications to it. In any case, one would need to think about the implications of following the cash flow principle through to its logical extreme. As I said, as interest rates have fallen, the present cost of future consumption has risen markedly. But what would we compare it with? Very low interest rates also increase the value of lifetime labour income, even if they don't do anything for your current labour income. And to compare a cash flow index with current income, if the cash flow index does really show the costs of things that people are paying for now by saving up for them, is highly misleading. On the other hand, it seems to me obvious that the ONS won't want to publish lifetime income figures on any regular basis or non-specialist basis, because you can construct them only by making assumptions about the future value of lifetime labour income, and the ONS is a statistical office, not a body whose job it is to forecast where labour income is going to be in 30 years' time. So all this suggests that it's probably best not to take the cash flow approach too far, and my own view is that it probably should be limited to the treatment of student loans, which is what we're doing at the moment. Let me wind up by some thoughts on the capital cost of housing. The previous national statistician, John Pullinger, did commit the ONS to producing a measure of costs which reflects capital costs of housing. Now, you can apply the cash flow principle to housing just as much as you can apply it to anything else. Mortgage capital payments reflect housing as it's paid for, but people also make payments from lump sums, inheritances, and gifts. And if housing is the main component of inherited wealth, then it would make sense to leave out inheritance finance, because the purchase would have already been paid for by the legator. So that suggests that we shouldn't worry too much about houses financed in other ways. Similarly, if people have already saved up for lump sums, then you would want to count the cost of the house when they're doing the saving up towards the deposit. You wouldn't also want to include it in the expenditure for the deposit. Where you start to have more difficulties is when people do equity withdrawal, perhaps to finance consumption in retirement. Now, that's a negative purchase of housing, and it should be accounted for as such. And you do need to take account of equity withdrawal when you look at capital costs on a cash flow basis. Otherwise, you have the same problem as we had with interest rates. How important is equity withdrawal? Well, all I can say is that for about 15 years, the owner-occupied sector was withdrawing equity. The rate of owner occupation was falling by about 0.5 percentage point a year. So what are the conclusions? That the HCI has some very valuable features, some features which I think it would be desirable to modify. The democratic nature, I think, is a strong plus, but I would urge the ONS to relate it to geometric means and not rely just on users to do that. The treatment of insurance distinguish losses from genuine consumption. So those are the plus points. The areas that could do for change. A focus only on interest payments gives a misleading impression of the impact of interest rate changes on people's living conditions, and that matters if the income data aren't produced simultaneously with the cost data. It's also difficult to give an index to a meaning to an index which works on a cash flow basis, and it's also difficult to apply the principle very widely. So perhaps I would not want to take that any further than has been taken already. With housing, the cash flow structure does accommodate it, but we would need information on equity withdrawal. Otherwise, that would again create a misleading impression of the effects of changes in house prices on living standards. So let me close there, and I'm happy to look at the questions and answers. So there's one from Andrew Baldwin, which I'd mentioned already. Why is it necessary to develop a theoretical framework? And my answer is that if you don't have a theoretical framework, you end up just with some view on how people what people's thoughts of inflation are. And I must say, it's very difficult to see where that has come from. I know the ONS consults through its Consumer Price Advisory Committee, but whether that is a means of assessing how households experience inflation, I must say, is rather doubtful.
Thank you, Martin. We might unmute Andrew to know if he has further comments on this, please. Andrew, normally you should be unmuted.
Can you hear me?
Yes. Thank you.
Oh, thank you, Paul. Yes, it seemed to me that the household cost indexes really should have been just an implementation of the household inflation index as it was conceived of by John Aston and Jill Leyland. Struck me it was a very decent framework, and it deliberately stayed away from strong theorizing on the basis that British households generally had a good idea themselves of what was consumption and what wasn't, and should adhere to it. When you get too much into theoretical underpinnings, you can get into dangerous areas. I think I've got a lot of respect for the cost of living index theorists who look for those kind of underpinnings, but but personally, I prefer the axiomatic approach choosing index number formulas and other areas as well. I was trained by Bowden Schultz, and he liked to tell the story. People are not sure whether they're is a collective cost of living index or not, but we do know that if there was such an index that was translogged, the Tornquist index would be compatible with it. He said it reminded him of the classicists saying that no one knows whether the Greek poet Homer lived or not, but we do know that he was blind. And
sorry.
Yes, and I was just going to say that I found that the household cost indexes, as they were calculated, left out equity payments on house purchases altogether, which I didn't like. Now there seem to be plans to bring in an HCIC that are where the equity payments are described as the equity payments related to mortgages, but they're when you could buy a house for cash, there's no mortgage, there's not anything. You know, that should be part of the cost of a house that should go into a household cost index, in my opinion. But before Joan and Jill, Ralph Turvey was a longtime chief economist for the International Labor Organization, really developed a theory behind a broad payments index, and Turvey certainly would have included a cash purchase of a house in his weights. And that was the approach that was actually taken in the experimental broadly defined payments approach that was set up by Statistics Canada. I set it up myself and was calculated for about 20 years. I'm not sure why it was discussed.
Sorry, could you bring your remarks to a close, please, because there are a number of other people who've asked.
Yes, I'm sorry. That's it.
Okay, well, my observation on that is that if you know, when do you pay for the house which is bought with a cash pile? And my answer is that you pay for that component of it when you're doing the saving rather than when you part with the cash pile. In other words, when you put the money aside from your income. The issue of equity release and inheritance does need to be considered, and in particular, if I inherit one house, sell it, and put the money towards a larger house for myself, then it seems to me very difficult to justify including that in a that gross transaction in a cost index, because whatever the price, if the prices of the two houses have moved in the same way, I'm not actually buying more housing, I'm just buying a different type of housing. But as I said, the ONS is committed to producing an index including housing, and I'm sure there will be some debate about how best to do that. Now, a couple of questions from Tony Cox. He has said that, he's referred to the paper that I also wrote. Reallocating costs appears to be predicated on regarding a pension as a good in its own right. The point isn't that the pension is the good in its own right. The point is that it's a prepayment. The money that I put into a pension is a payment out of my income for future consumption. Tony also asked me to comment on the point. Let me read his second.
Tony has been unmuted, so is able to ask his question.
Sorry.
No, I'm happy for you to continue, Martin. On the pension point, yeah, I mean, I see what you're saying, but I think that most people, when they pay for a pension, when they make the payments for a pension, they are regarding that as the service that they're buying. They're buying the pension there and then. And therefore, you know, we don't need to worry about what the pension money is going to be used for at some point in the future. That would just confuses the whole matter. That was my point on that, but I'm happy for you to proceed with the next point. I mean, just to say, I have reservations about including pension payments in a price index of this nature, but I mean, that's a whole separate argument, which could go on for a long time, so I don't really want to pursue that now.
Well, I mean, I agree with you. I mean, I can certainly see practical difficulties in spades, but no, I mean, your point about the way people see pensions and pension payments, I find myself wondering, how do we know how people see them? And no, the theoretical framework at least provides a basis for assumptions about the way people see them. No, we certainly haven't conducted a large survey or even a small survey to find out how people see interest payments. So, I mean, you say in your second question, the HCI was originally envisaged as an index that measured changes in prices experienced by households, not as appears to be the basis of this treatment of living standards. Well, what do we mean by prices as experienced by households, unless you relate that to the particular things that they buy, and then you need some basis for saying what you count and what you don't count. So, I mean, this is perhaps in some sense the core of the issue. I do have a lot of difficulty with an index which is constructed on some assumption about household behaviour, but without any clear basis for knowing what that behaviour is.
Thank you, Martin.
So should we go on to David's question, please?
Yes, David, you should be unmuted normally.
Okay, I hope you can hear me. Thanks, Martin. That was a really interesting talk, as usual, lots of food for thought. I have a quick question just on whether you have any ideas or thoughts on how these indices you're describing could potentially account for the increasing amount of household consumption and the time that we spend in these kind of consumption that is actually free at point of use for the user. Thanks.
Well, I mean, if we think of the big component of free consumption, it presumably is health services, and the tradition has been that we haven't reflected any costs for health services beyond prescription charges and things like that. We haven't reflected any costs for health services in the consumer price index because they are free at the point of use. Now, I think that probably principle probably also relates to other free goods like wireless and television transmissions. I can watch as much of the BBC as I want for the license fee, so I pay the license, but I don't pay I don't pay a charge for the amount of television that I actually watch. The same is true with going into museums and things like that. So if we want a cost of living index, then we have to reflect expenditures that people actually make, and they don't make expenditures on free goods.
Okay, thanks.
Thank you, Martin. Now there is another question from Jill Leyland.
Hello, Martin.
Hello, Jill.
Thanks as always for a very thought-provoking presentation. Now, I agree that a framework is needed. I don't think it necessarily has to be on economic theory. Indeed, our aim was to was not to base it on economic theory, John Nastin's and mine. So our framework has always been that it is a day basis. Now, I appreciate many of your arguments, but on interest income and also equity withdrawal, the latter, of course, is not yet included in any sense, then I don't quite understand why you wouldn't be happy that these are not, that these could be covered in income. And I think your only argument on that was practicalities, but the answer to that is to improve the statistics. And I would have assumed that the aim of a theoretical approach is to work out the ideal, and then surely you try to get as close to that as possible in practice. So that's why I'm not really sure why you're unhappy at the idea that interest income is included in the income side.
Well, I can see that you can produce, one can produce a coherent framework in which that's done. It is the practicality which worries me that, cost indices, I think the ONS is producing them quarterly, but presumably once they become mainstream national statistics, they'll be published quarterly without any material delay, and the income data, the relevant income data, are unlikely to be available with the same frequency. Now, that may change because, of course, HMRC has been producing administrative income data, and it is possible to produce estimates from PAYE data on a very timely basis, or at least the ONS may be able to produce flash income estimates which it could release with the HCI expenditure measures. And if that does become possible or is a reasonable goal, then I think my concern would be met.
Okay, thank you. Just to add on, if I could, quickly on mortgages, I agree with you that capital payments on, from inheritance and stuff are a problem. I'm thinking more of the sort of regular payments that people make, but that's probably an argument for the future.
Well, the regular payments, as I say, I think it's fairly easy to see how you handle those. You might take the view that the cash flow framework is only partially cash flow framework and decide that that's where you'll stop. But I must say I would have, and perhaps you were saying that as well, a lot of concerns about Andrew's point of including lump sum components in this cost of, in this capital cost of housing, because if we include the lump sum components, then we would need either to put the equity release or the inheritances into income, and I think we can be fairly confident that those aren't going to find their way into income on a timely basis. We have very little basis for measuring those.
Thank you. I mean, I agree with you on that particular point, that it's debatable.
Perhaps we can, John can ask a quick question to end the discussion. John Astin, you should be unmuted. Be able to unmute yourself. Thank you.
John,
yes.
We still can't hear you. You are demuted, but we can't hear you.
Okay. So then if you, John, if you can just send an email to Martin with your question, then thank you. I will end the seminar now. So thank you very much, Martin. And the next seminar will be on the 28th of January, and Joe Meehan will be presenting his work on offshore profit shifting, on the effect of offshore profit shifting on the measurement of GDP. Thank you, everyone. Goodbye.